Hello everyone, welcome back to Daily Wall Street, your go-to source for the latest market trends and financial insights. Today is March 20th, 2025, and we have a crucial topic to discuss. Is Powell's putback? Are we seeing the beginning of an escape rally? For those unfamiliar with the term Powell's put, it refers to the market's expectation that whenever a severe downturn or financial crisis occurs, Fed Chair Jerome Powell will step in with accommodative monetary policies to stabilize the economy and prevent a major collapse. Given the current market volatility, investors are now closely watching the Fed's next move. Yesterday, the FOMC meeting concluded, and as expected, the Fed decided to keep interest rates unchanged at 4.25 to 4.5%. However, what really fueled the market's rally was Powell's dovish tone and the Fed's unchanged projection of 2 rate cuts before the end of the year. Markets responded extremely positively to this stance. The Dow Jones Industrial Average jumped 0.9%, the S&P 500 climbed 1.1%, and the Nasdaq 100 gained 1.3%. The Philadelphia Semiconductor Index also rose by 1%, and the Russell 2000 surged 1.6%. Notably, this was the best Fed decision day performance for the S&P 500 since July 31, 2024, and for the Dow Jones since March 20, 2024. Futures markets continued this bullish momentum into today's session, indicating growing investor confidence. Despite this optimism, the real question is, how sustainable is this rally? The Fed's latest dot plot projections still indicate 2 rate cuts in 2025, bringing the federal funds rate to 3.9% by year-end. However, within the FOMC, there's a notable shift. More officials now expect fewer rate cuts, signaling a more hawkish internal sentiment than before. Meanwhile, Treasury yields dropped following the Fed's decision. The 2-year Treasury yield fell to 3.98%, while the 10-year Treasury yield declined to 4.26%. This reflects expectations that the Fed will maintain a looser stance, supporting risk assets like stocks and gold. Gold prices surged once again, continuing their strong uptrend. The gold ETF gained 0.4% yesterday, reinforcing that investors are still betting on gold as a hedge against economic uncertainty and potential rate cuts. The impact of the Fed's decision overshadowed Nvidia's GTC conference. While Nvidia CEO Jensen Huang introduced new AI chip technology, the market reaction was muted. Nvidia's stock initially dropped 3.4% on disappointment, but has since rebounded by 1.8% today. However, its inability to fully recover. Yesterday's loss suggests that the market's focus remains on macro trends rather than tech developments. Another key player in this market is Tesla, which continues to struggle. The stock has been on an 8-week losing streak, declining 44% year-to-date. The pressure on Tesla intensified after BYD unveiled its latest ultra-fast charging technology, further challenging Tesla's dominance in the EV market. So, what does this mean for investors? From a technical perspective, the S&P 500 remains near its highs, but market breadth indicators suggest weakening momentum. The advanced decline line has been declining, signaling that while indices are holding up, fewer stocks are actually participating in the rally. This means a more selective approach is necessary. Defensive sectors like consumer staples, healthcare, and utilities underperformed, while big tech stocks led the rally. Companies like Microsoft, Apple, Amazon, and Google all posted solid gains, while Tesla outperformed with a 4.7% rebound due to a fresh analyst upgrade. Another important trend to watch is CTA positioning. According to Goldman Sachs, CTAs have stopped selling and are now turning into potential buyers. Currently holding $30 billion in short positions, they are expected to buy back up to $90 billion in global equities over the next month. $45 billion of that could flow into U.S. stocks, potentially fueling further upside. However, we must be cautious. The Fed's economic projections downgraded 2025 GDP growth from 2.1% to 1.7%, while also raising inflation forecasts to 2.7%. This stagflation-like scenario could pose risks later in the year, particularly if wage pressures or supply chain issues reignite inflationary concerns. For now, the market has embraced Powell's dovish stance, but the real test will be whether inflation and economic data in the coming months justify these rate cut expectations. So how should you position yourself in this environment? For short-term traders, the current rally could continue in the near term, but be cautious of resistance levels and watch for profit-taking. For long-term investors, focus on fundamentally strong companies that have been oversold and could benefit from an eventual rate cut cycle. Keep a close eye on Fed speeches, inflation reports, and key earnings results to gauge whether this rally has real staying power or is just a temporary bounce. As always, be disciplined with your risk management and position sizing. That's it for today's analysis. If you found this breakdown helpful, don't forget to hit the like button, subscribe to Daily Wall Street, and turn on notifications so you never miss our latest updates. Let us know in the comments what you think about Powell's latest move and how you're positioning your portfolio in this market. Thanks for watching, and we'll see you in the next one.